Outside, I would like to thank Taxmann for giving me opportunity to share my views on applicability of GST on real estate industry. Straight away going to the topic subject proper. There are certain questions coming down right away on the chat box, but we'll take care of that at the end of the session or during the sessions if at all your questions are answered. Yeah. So this is the agenda, taxability pre and post 31st March 2014. So 1st April 2019 was the date wherein major changes were proposed or major changes were made applicable for so far as a developer is concerned. Then we'll deal with certain charges applicable with GST on certain charges that are collected by the developers. Conditions to be fulfilled for new residential project. That was the one of the major thing because after 1/4/2019, the new rate or the reduced rate of 5% or 1% was made applicable. We'll discuss briefly upon the transfer of development rights and transferable development rights, long-term lease that are applicable in real estate industry, redevelopment models, taxability and valuations. We'll also deal with the Rule 42. That also pre and post 1/4/2019. Plotting of land, one of the most talked about topic so far as real estate is concerned, and certain recent litigations or the major litigations that are faced by the developers or pending with the various courts. Before we go to the subject proper, I just want to deal upon or briefly touch upon the indirect tax structure. So basically, before GST came, excise, service tax, customs, and sales tax and entry tax was taxable. The taxable event was different taxable events. So for excise duty, it was manufacture. For sales tax, it was sale, and for entry tax, it was entry of goods. So all this was merged except the customs duty, and the taxable event so far as GST is concerned is made supply, and supply has been properly defined under GST. A very exclusive and inclusive definition of supply is there in GST. Thus, okay. So the entry number 49 of list 2 of schedule 7 schedule article 246, that was dealing with the taxes on land and building in the state subject. So this needs to be amended, or this was amended and by the constitution to give the concurrent powers to both center and state. So for taxing a developer or a particular immobile property, we need to have taxing powers to both state and center, which was not there prior to this constitution amendment. Now, what happened during that amendment was that Article 366(26)(a) of the Constitution refers to the definition of service. And service means just a brief definition says that service means anything other than goods. Now, because this is very important, because when we say anything other than goods, so everything under the sky is covered under the definition of service. And the more appropriate question or more pointed question is that whether immobile property is also covered within the definition of service, because this is what the is before the Supreme Court in a recent judgment that we'll discuss. Then, of course, Schedule 2 has been treated as a classification of services and goods so far as GST is concerned, and works contract is classified as it's defined or it's classified as a service per se, even though there might be a supply of goods involved. So starting with this, we'll go with the basic understanding of construction sector. Recently, in previous slide, we just discussed about the definition of goods. Everything, every kind of movable property other than money and security, but includes actionable claims. So this is the definition of goods. Now look at the definition of service. Service means anything other than the goods. So, and of course, there are certain exclusions like money and security, and there's certain inclusions are there. But what about summarization that I want to do is that the service means anything other than goods. Now, why I'm saying this, that because in somewhere in 2015, when this GST was discussed in Rajya Sabha, some members said that this is a very open-ended definition, saying that anything other than goods. So you have to say something like accept the taxes on supply of alcoholic liquor and progressively ensure the true common market of all goods is covered under the GST. Now, what the government views were there at that point of time, the Department of Revenue said that services has been so defined in order to give it wide amplitude so that all the supplies that are not goods can potentially be covered within the ambit of services. Now, this is what the thoughts of government were at that point of time, and this is what the government thoughts of government are now at this point of time. Now, why this discussion about anything other than goods is that because the larger perspective is that whether the transfer of development rights or transferable development rights or FSI are taxable within the definition within the purview of GST or not. That is something we'll discuss. So having built a preamble about that, we'll jump directly into the law proper. As I said, the Schedule 2 is basically classifying. So the classification says that construction of complex shall be considered or classified as a supply of services. So construction of complex, building, civil structure or a part thereof, including a complex or building intended for sale to a buyer, wholly or partly, except for the entire consideration has been received after the issuance of completion certificate were required by the competent authority or after its occupation, which is earlier. So what does it say? That if any commercial or a residential unit being constructed by a developer, and if any advances are received, so it's intended to sell to a customer. So if any amount of advances are received towards that particular unit or the flat, then on the entire consideration that has been agreed upon by the between the developer and the customer will be covered under the GST, or GST will be applicable on that. And if any no advances are received and completion certificate is being issued or is received and by competent authority or after its first occupation, then the entire amount of consideration received will not be covered under GST. So this is the basic understanding of GST or applicability of GST on a developer activity done by the developer. Now, while we were discussing about that covering of immobile property within the definition of service, what distinction it made between the the earlier service tax regime and now GST regime. Schedule 3 provides certain list of transactions which are neither supply of goods nor supply of services. So that these type of transactions are outside the purview of GST. When we say that outside the purview of GST law cannot be made applicable to such transaction. One of the transaction is sale of land. Sale of land means a sale of land, a simplicity transaction of sale of land. That is what we understand by the way it has been worded. And the another is a sale of building. Sale of building means any unit that is sold after the completion certificate is received. So if we correlate the taxability as defined under Schedule 2 and the exclusion as defined under Schedule 3, then a sale of building before receipt of completion certificate, then it would be taxable. But after the complete receipt of completion certificate, it will not be taxable. It will be outside the purview of GST. Why I'm saying outside the purview? Because it will neither consider supply of goods nor supply of services. So it is not a exempt supply, or we cannot. So it's a non-taxable supply. It's a no supply. It's a no supply actually. Of course, it is an exempt supply for the purpose of reversal of ITC that has been specifically given in section 17. But otherwise, for that limited purpose only, otherwise it is no supply. A GST law cannot be made applicable to this type of transaction. So hence, where the completion certificate is not received in case of residential or commercial units, and if any advances are received, then all the entire transaction will be covered under GST. Now, this I just want to briefly touch upon the various definition that has been covered under other statutes like General Clauses Act, Real Estate, RERA Act, Transfer of Property Act, Registration Act, Land Acquisition Act, and Bombay Revenue Land Revenue Code. So again, this is somewhere again touching upon that particular transaction of transfer of development rights, whether that is considered as taxable or not. Because as we saw that in this service tax, that is the definition of service is excluded the immobile property. So this is the major distinction in service tax and GST, that therein immobile property itself was excluded. So immobile property means you can say that it shall include land as well as benefit arising out of land. So benefits arising out of land was clearly excluded from the definition of service, and hence it was outside the service tax perspective. But in GST, it's merely land. Now, one can say that if we refer to the Land Acquisition Act, then land includes the benefit to arise out of land. That type of argument can be put forward. Even in Bombay Land Revenue Code also, land includes benefit arise out of land. So any benefit that is arising out of land can be included in land, and can be said that, okay, the sale of land there is there in Schedule 3, exclusion of the supply. So that exclusion we can apply to that particular benefit arising out of land also. We'll see. Now, the summarization of discussion that we had so far is now: sale of land with some development, because this is also one of the topic today where that we are going to discuss, plotting of land. But okay, with certain development like leveling, laying down drainage line, water line, electricity line, no GST will be applicable. Sale of building, if entire consideration is received after the issuance of completion certificate, then no GST. But part or whether full consideration is issued before the issuance of completion certificate, or we can say building use permission BU, that is what we refer over here in Ahmedabad, then it is then the entire amount will be taxable under GST. So a brief example has been given. A unit A for which payment is received, the entire 50 lakhs is received after CC, so it is exempted. Unit B, 30 lakhs is received before CC and 20 lakhs is received after CC. So entire 50 lakhs will be taxable. It's not like that the amount that is received after CC will be exempted. If a single rupee is received before CC or BU permission, then the entire amount will be taxable. So having understood the basics of the taxability, let's get into the applicability of GST. So that were there during the, right from 2017, July 2017 till 31st of March 2019. What happened was that GST was applicable on the residential unit at the rate of 12%, effective rate of 12%, by reducing this 1/3 of land value. So that amount was very, that a percentage of 12% plus 6% of stamp duty, or of 5% of stamp duty, resulted into, escalation of 18% over and above the price of a particular unit. And then it was proposed that, or it was appealed before the government, that this is too high for, a residential unit. So after 1/4/2019, or from 1/4/2019, the government came out with this percentage of 5% without ITC. And for affordable units, it was 1% without ITC. So for commercial units, it remained 12% with ITC, 12% with ITC. When I'm saying 8%, 12%, it's an effective rate. Otherwise, it is actually 18%. For 1%, it is around 1.5%, and for 5%, it is 7.5%. We'll see in the next slide. So what happened that for up till the 31st of March 2019, the tax rates that were applicable was 12% effective rate for residential complex for non-affordable units with ITC. So input tax credit was allowed, so it was eligible for that particular transactions. Now after 1/4/2019, they've done away with the ITC eligibility, and 1%, 5% of reduced rate is applicable as of now. So as of now, what we if any project the builder is starting, that for residential complex it would be 5% without ITC, and for commercial complex it would be 12% with ITC. Works contract service, it's throughout the period 18% with ITC. On certain government contracts, it was 12%. But as of now, after 18th of July 2022, they have done away with that reduced rate of 12%. Every works contract is taxable at 18% with ITC. Prior to GST, during service tax, it was, there was a bifurcation that in case of original works, that some amount of goods are involved, major amount of goods are involved, so 6%. In maintenance and repairs, it was 10.5%, and in services, it was only 15%. Only services, it was 15%. So this is merely comparison sort of thing before GST and after GST. Now, what happened after 2019? That they came out with these new definitions. They defined every real estate project into two parts. One is residential real estate project, and another one is real estate project. What differentiation they made is that, as per the notification 3/2019, they say that where in any particular project, if a commercial apartment area, the commercial apartment area as compared to the total carpet area, and that carpet area needs to be considered as per the RERA. If it is not more than 15%, then it will be considered as residential real estate project, so RREP. And if the commercial carpet area is more than 15% of the entire carpet area, if you consider 15% is more, commercial apartment area is more than 15%, then it will be considered as a commercial project, or they termed it as a real estate project, REP. So this is the distinction, RREP and REP. RREP, so these are the permutation combination that we have put in any particular RREP. If a commercial apartment area is not more than 15%, then it can consist of It can be of merely affordable housing. It can merely of non-affordable housing, affordable plus non-affordable. It can be affordable plus commercial, non-affordable plus commercial, and affordable plus non-affordable plus commercial. So this can consist of any permutation combination. So similarly, it can be in REP as well, but the commercial carpet area will be more than 15% in an REP project. So what are the rates applicable? So why I was saying about this permutation combinations or the mix of affordable and non-affordable, because the applicability of rate will be like this. If a project is RREP, an affordable housing project, then affordable housing, it would be 1%. Non-affordable, that is normal residential project, it would be 5%. RREP means residential real estate project. So wherein the obviously commercial apartment is less than 15% or up to 15%. RREP affordable 1%, non-affordable 5%, and this is very important. The commercial part will also be taxed at 5% without ITC. So this is the difference. Even though commercial units are there, the 5% rate will be applicable because the entire project will be termed as RREP. So residential real estate project, and commercial maybe 5-10%. We have the type of apartments, a high-rise apartment wherein first ground floor or first floor will be of offices and certain shops and all. So that type of projects will obviously consist of commercial apartments, commercial units, but that would be less than 15% of total carpet area of the project, and it would be termed as an RREP. So the commercial part will be taxed at 5%. Now coming to the commercial apartments, where there will mix of residential and commercial, and wherein commercial may be more than 15%. Then in that case also, if unit is affordable, then 1%, non-affordable, then 5%. But the commercial part, it will be taxed at 12% with ITC. Now, all the rates that I'm saying as of now, 1%, 5%, 1% are effective rate of tax. We'll see in the next slide that what are the actual rate that has been mentioned in the notification, because as the notification 3 said, that value of transfer of land and undivided share of land is to be considered or deemed as 1/3 of total amount of such supply, and hence it is to be reduced. So we have considered that thing as an effective tax rate. Otherwise, yeah. Otherwise, the rates that are applicable as per the notification are: for affordability, it is 1.5%, and 1/3 is to be reduced from the value. Non-affordability, it is 7.5%, and value is 1/3 is to be reduced from the value. So if we see that non-affordable, if a amount that has been received is 1 lakh of rupees, then taxable value will be 66,000, and the rate will be 7.5%. So if you'll apply 5% directly on 1 lakh, the arithmetically it will come correct. But correctly, the correct manner of presentation will be 1 lakh minus 1/3, that is the land portion, that is the taxable value, 66,000, and on it 7.5% will be applicable. So this is the correct mechanism by which it should be shown. Okay. Now, when the department came, our government came with this amendment or change from 1/4/2019, there were some obviously the business was going on, the number of projects were across the countries were going on. So the government gave an option that for ongoing projects, you can opt for whatever older rate that were applicable, and if you don't want to opt, then you can switch over to the new rate as well. So if a project was running at that point of time, I can opt for a particular saying that I'm opting for the older rate by filing an annexure with the department. And if that has not been filed, then automatically I would be covered under the new regime or new rate that is applicable from 1/4/2019. So this is the comparable theme that I've given. 5%, as you can see over here, that the difference is in the commercial unit, wherein the carpet area of the commercial apartments is less than 15% in a particular project. It was 12%, it is getting taxed at 5%. Yeah, so this is what I was discussing, that a full rate of tax is 1.5% for affordable. Then effective rate, we can say that it's 1%, non-affordable 7.5%, effective rate is 5%. And commercial units, the rate is 18%, but effective rate is 12%. And works contract, obviously, it is like 18%. Now, how there are number of, there are different perspective that how you should disclose so far as this type of transaction are being undertaken by developer in your GST returns. Our recommendation is that this type of disclosure is not proper. The disclosure must be like the taxable value of 66,000 on each on which 1.5% or 7.5% or 18% should be made applicable, and accordingly tax should be calculated. So this can be the ideal way of disclosing this particular transactions in your GST returns. Now, regarding this one third value that is to be deducted for the land. It was challenged in Gujarat High Court in a case of Munjal Manish Bhatt, wherein Gujarat High Court appreciated the petition filed by the petitioner. And petitioner said that when I can find out an actual value of land in a contract, why I should deduct only one third? Why I cannot reduce the entire amount of land? Because taxing the land is ultra virus GST. You cannot tax the land. And if I'm giving you the actual value of land, then you should consider the actual value of land rather than going to the deeming fiction of one third value. If at all I cannot give the actual value of land, you can go ahead and tax that one third value of the land, one third value. You can deem it as a one third value and remove it from the transaction value and then tax the remaining two third. But where I can provide you the exact amount of land value involved, that cannot be taxed under GST. So Gujarat High Court appreciated this particular thing, and it passed this particular judgment in favor, saying that it is held that mandatory adopting one third of total amount charged towards the value of land in construction contract in case of land cost is ascertainable is ultra vires the provisions as well as the scheme of GST law. So Gujarat High Court said that mandatory deduction of one third of value of land in construction contract is not sustainable in cases where the value of land is ascertainable and where the value of construction service can be derived with the aid of valuation rules. So this has been ruled. Now, obviously, department has approached Supreme Court, and this particular matter is pending with Supreme Court as of now. So they will see what Supreme Court gives their view on this particular ruling. But if we consider the value of as per Gujarat High Court, then let's just take a scenario. In scenario A, the total construction and total value of unit is 1 crore and 20 lakhs. And if I can provide the value of land as per the contract, this can easily be done in a bungalow or villa construction. So 60 lakhs is towards land. So obviously the remaining part will be the 40 lakhs, and land value that is to be reduced will be 60 lakhs. So out of 1 crore 20 lakhs, only 60 lakhs can be taxed. Apart from that, if you look at the scenario C, 1 crore 20 lakhs, the value of land is 30 lakhs, and the value of land is 30 lakhs, and that amount can only be reduced, and in remaining 90 lakhs GST can be charged. Now, in scenario D is something that what the GST law says as of now, that if you cannot ascertain, this can happen in your the commercial units or maybe in residential flats and all this, that you cannot actually identify the value of undivided portion of the land to the customer, and on that one third applicability is okay, so that can be applied. So we'll wait and watch what Supreme Court says in this particular thing. This is something I've covered about the disclosure in your GST returns, because see, real estate is not like any other supply of goods or services wherein you raise an invoice, and if at all there is some rate variation or goods return, then you issue debit notes and credit notes. It does not work like that actually. So in normal cases, the developers issue a advance receipt voucher on receipt of advances, and at the time of sale deed, when they enter into sale deed, then a final invoice is raised. Till that all the taxes are paid on the basis of invoices, on the basis of advances that has been received, or maybe in certain cases if the milestones are defined in agreement to sale. If any milestones are defined in agreement to sale, then on the basis of demand note, that is considered as invoices. So this is the basically the disclosure that we follow while filing GST returns of a developer. That value of invoices on a sale deed of unit, or maybe during the milestone. If an invoice is raised, then and accordingly and following to that invoice, if any debit note or credit note are raised, then that disclosure is done in table number 4.5 of GSTR1 table of GSTR1. And if the invoices are not raised, but only receipt vouchers are raised throughout the construction period, then that particular thing is shown. The entirely thing is shown in table number 11 of GSTR1. And of course, for the units that are sold after BU, that is that are exempted from GST, so bill of supply, that we disclose in table number 8, and for table number 8 of GSTR1, and GSTR3B table number 3.1 A, it's the consolidated amounts. There is no distinction so far as that is concerned. Yeah. So summarizing the entire thing that we've discussed about the rate applicability and ITC eligibility. So from the period 1/7/2017 till 31st March 2019, 8%, 12% effective rate. 8%, 12%, and 12% is applicable on residential and commercial units, and ITC was eligible. So payment can be done by way of cash and credit, so ITC. But from 1st of April 2019, RREP, the projects wherein the commercial area of commercial units of the as compared to the entire the area of the entire project is less than 15% or equal to 15%, then 1% and 5% of reduced rate were applicable. And mind you, you cannot take the credit, so ITC cannot be availed, and that payment also needs to be done in cash. So one can say that I am having two different businesses, and I am having ITC, eligible ITC of one business. So can I use it for the discharge of liability of 5%? That also cannot be done, because the dischargement of liability of 1% and 5% of residential units after 1/4/2019 needs to be done only by cash. That cannot be done by the credit, and ITC cannot be availed. That is another thing. And commercial, yeah, ITC can be availed for 12%. It remains same. Having understood the basic structure or basic tax applicability and valuation part on the commercial and residential units pre and post 1/4/2019, let's just briefly discuss upon what could be the taxability on the um, other charges. So some ancillary charges that a developer generally, obviously, it's not a simpliciter transaction that one consolidated amount. There are a number of charges like preferential location charges, floor rise charges, electricity meter charges, etc., etc. So that all charges are collected at the time of entering into sale deed with the developer. For that, we need to understand the concepts of composite supply, mixed supply, and principal supply. And the definition or the definition of gross amount that has been referred in the notification 3/2019. Of course, if we can merely refer to that particular definition, then also we'll get certain answer that a gross amount shall be the sum total of amount charged towards the transfer of land or undivided share of land, as the case may be, which may include by way of lease and sublease, and amount charged by the promoter from the buyer of the apartment, including preferential location charges, development charges, parking charges, common facility charges. So all such charges are, basically the gross amount that is the charge. So what could be the next applicability? So this was something that has been asked in an advanced ruling. This is some sort of clarificatory sort of advanced ruling that we can refer to that certain charges like water connection charges, electricity meter charges, including preferential location, floor rise, development charges, legal fees, these all are inextricably linked and naturally bundled with the basic value of the unit. So that needs to be charged at the rate of the construction service, that is 1%, 5%, or 12%, again, effective rate. But there are certain charges which are not, related or connected to that particular basic value. So clubhouse maintenance charges, advance maintenance for the society that society collects at the time of entering into sale deed. Then there are certain other charges also, say municipal taxes, obviously. If you refer to section 15, then it says that any taxes other than GST are also covered. So one can say that if it has been collected and it's not covered within the definition of pure region, then on that also GST can be charged at 18%. So this can be the summarization of this is what we understand basically on the applicability of GST on other charges. So electricity, sewerage, water connection charges, common infrastructure development charges, advances, that is what the basic sale price, PLC, floor rise, parking charge, legal charges, subscription charge, booking fees, administration fees, other miscellaneous, clubhouse development charges, internal development and external development charges, that can be covered under the, the basic rate structure. But the membership of club, it is a different service altogether, and it would be covered as 18%. Maintenance deposit, obviously, deposit is not to be taxed, as it is not covered in it is clearly excluded from the definition of consideration. Unless it is applied for the supply, it remains deposit, and it remains deposit, so it would be excluded from the definition of consideration. Stamp duty and registration charges are directly paid by the customer to the government. So again, that is not the case. Now, membership of club, charges for cancellation of booking, and extra civil work charges, these, according to me, can be said as are not covered under the basic rate of 8%, 5%, or 12%, and 18% should be applicable on this. So having drawn an analogy from the notification, then the section 15, referring to briefly to the AAR of Puranik builders. This is the summarization that we prepared, that tax should be applicable in or rate should be applicable in such fashion on different components charged by the developer. Now, after this, coming to, briefly just touching upon the maintenance charges, 7,500. It was obviously clarified that 7,500, if it's collected by residential welfare society, residential welfare association, and if it is below 7,500 per unit per month, then it's not taxable or exempted. It is exempted, and if it is more than that, then 18% GST will be applicable. However, if it is there in commercial society, and if it is, or rather it is a residential society, but collected by, some a private limited company or CAM company formed by the developer himself, then also 18% GST will be applicable, because that collection of, even though it would be less than 7,500 per unit per month, but that collection will not be done by any residential welfare society. So this exemption is, qua provider, service provider, as well as the limit of 7,500. So both things needs to be tested while deciding whether that exemption is applicable or not. So similarly, 20 lakhs of the basic limit will be applicable, along with, coupled with that exemption limit of 7,500. So even though my limit exceeds 20 lakhs, but the maintenance charge is collected per unit per month remains below 7,500, then I need not pay GST on any amount, even though that the annual collection may exceed 20 lakhs, because I am having this exemption of 7,500 per unit per month. And since the entire collection is exempted, even I am not supposed to get the registration, because my entire income is an exempted income. So these are some permutation combinations which we have tested, that whether on which GST will be applicable and which exemption can be claimed. Now, as we discussed, that 1% rate is applicable in affordable housing. Now, what do you mean by affordable housing? Affordable housing has been defined in the notification 3/2019, that was made applicable from 1st of April 2019. So there are two conditions that needs to be fulfilled simultaneously. One is about the area of that unit, and that when I say area, the area means it must be a RERA carpet area, not this built up area or super built up area or anything that developer says, but the area that has been reported to the RERA authority by the developer, that RERA carpet area needs to be tested. So for metropolitan city, including Bangalore, Chennai, Delhi, NCR, Hyderabad, Kolkata, and Mumbai, the area is 60 square meters. The first condition is that the must be less than or equal to 60 square meter. That the unit of, and this is only for residential, this is not for commercial. So for getting covered under the definition of affordable residential unit, the first condition needs to be fulfilled is it must be less than or equal to 60 square meter RERA carpet area. And if it is non-metropolitan, then instead of 60, it is 90. So this condition, area condition, is condition number one. And so this, and again, this is again a simultaneous condition that needs to be fulfilled, that, and the total value of residential unit, whether it's metro or non-metro, must be less than or equal to 45 lakhs. When I say 45 lakhs, what can consist of 45 lakhs? So again, before going to what can consist of 45 lakhs, let's just refresh it again. For metro cities, 60 square meters. For non-metro cities, 90 square meters, RERA carpet area, and the total value, if it is below or equal to 45 lakhs, then this reduced rate of 1% will be applicable. And if for ongoing project, then 8% will be applicable. Now, the total area that we referred, the gross amount, yeah. So this is something that we referred. What should be the gross amount that 45 lakhs should consist of? The amount of total charge, so inclusive of that undivided share of land plus the construction services plus the other charges such as the preferential location charges, development charges, parking charge, everything. So all such charges needs to be added. So all these charges needs to be added, arriving at the amount of 45 lakhs to say that this is affordable house, and accordingly 1% will be applicable. So, and this was also clarified by one of the FAQs that were issued specifically for the real estate industry. Apart from this, there are some other, affordable schemes that were defined in the notification, the rate notification 11/2017. So these on this also units were considered as an affordable housing on ongoing project under affordable housing scheme. So this is an example with various permutation combinations. So again, that's total value charged towards zero of rent, and other charges including preferential and parking charges, common facility, etc., all should be considered for the 45 lakhs of amount. Now, if I am selecting for the concessional rate of 1% and 5%, or I mean, this is for ongoing project, if I'm selecting for this concessional rate or any project that is after, started after 1/4/2019, then these are the 6 conditions that we need to fulfill. It's not like that we are paying 5% or 1% of reduced rate and no other condition is to be fulfilled. These are the 6 conditions that are mandatory to be fulfilled for for the concessional rate of 1% or 5%. First condition, as we discussed, that GST is to be paid only by cash. It cannot be paid by any ITC, utilization of ITC. You cannot even avail the ITC of that particular project, and you cannot even pay the GST of that project using any other eligible ITC. So 5% on 1% is required to be paid by cash only, no ITC. ITC, maintain project-wise ITC. You have to maintain this project-wise ITC, and ITC that you are not availing needs to be disclosed in GST 3B. That this is something which is a bit, cumbersome. That the government is not allowing me to take the ITC, but it wants me to, the keep track of ITC which I'm not availing, and I have to report it in GST 3B, showing it as that I availed this ITC and reverse this ITC. Then mandatory 80% I needs to purchase from a registered dealer, input goods and input services. So whatever input goods and input services that I'm taking for that particular project, I needs to compulsory purchase from a registered dealer. So registered dealer who will be charging obviously GST on me. So I cannot go to an unregistered dealer. So 80% is the cap that I have to do. And if I'm not fulfilling that particular 80%, then on the shortfall amount, I have to pay 18% GST under reverse charge mechanism, that is RCM. So this is again a bit of stringent condition. Apart from that, because when we say that 80%, it's covering only input goods and input services. Now, in input goods, they have carved out cement, and apart from input goods and input services, there is another thing that is capital goods. So for cement and capital goods, it is a mandatory thing to purchase from a registered person only, registered dealer only. If you're not purchasing capital goods or cement from a registered dealer, there is no cap of 80% as such on that particular thing. You have to mandatorily pay at the rate of that particular goods, I mean capital goods or the cement, that is taxed at 28% under RCM, and then it would be considered as your a part of that 80%. So apart from cement and capital goods, all input goods and input services, you have to balance out this 80% purchase from a registered dealer. For cement, enter 100% from the registered dealer. For capital goods, enter 100% from the registered dealer. And if that is not followed, then you have to pay under RCM of that particular rate. I mean, cement at 28% or capital goods for whatsoever rate is applicable to that particular thing. Now, obviously, for input goods and input services, there certain exclusions are carved. For example, TDR, transfer of development rights that you need not consider in that thing. Long-term lease, electricity, HSD, motor spirit, natural gas. So for coming for that, 100% on which I'm following that 80%, then these all needs to be carved out. These all need not be considered. And then this 80% will have to be calculated. And if I know at all there is shortfall, then taxpayer needs to pay tax at 18% under RCM and required to submit the details in prescribed form on GSTN by end of the quarter following the financial year, that is 30th June. So I have to calculate it across the year to fulfill that. If I'm not fulfilling that particular limit, then after the end of that financial year, in the month of June, that is by 30th of June, at the end of the quarter of the following the financial year, I have to pay the 18% under RCM, and accordingly, 18% will be paid on that remaining part shortfall. Now, of course, as I said, that there are certain exclusion that has been carved out not to be considered for that thing are development rights, then long-term lease land, FSI, electricity, high-speed diesel, oil, motor spirit, natural gas. And there are certain FAQs as well, purchase of land, salary cost, that has been clarified that this needs not be considered for calculating that 80%. Or the differential 20%. So this needs to be removed after before you start calculating the 100% from which 80% is carved out. In our view, this all expenditure also needs to be carved out or removed. Provision of expenditure, stamp duty, franking cost, interest cost, borrowing cost or fees paid to government. Now, issue over here is that mandatory purchase of 80% to be computed only for input goods and input services. So capital goods mandatorily from the registered dealer, and as well as cement also mandatory from the registered dealer. As per FAQ number 2, inward supplies of exempted goods services shall be included in value of supplies from unregistered person while calculating the 80% threshold. So interest is exempted under GST law, whether interest paid to banks which are registered under GST is to be calculated as supplies from registered or unregistered dealer. To my mind, it should be considered as a registered dealer, and hence there is no need to pay under the reverse charge for the differential part. And the excess or shortfall from the mandatory threshold not to be set off in the next year. So every year it needs to be calculated and paid before the June following the financial year. So this can be summarized in this manner, that total procurement of a promoter for the project. Now remove the non-GST expenditure or the expenditure that are not to be considered, excluded for the calculation. That are TDR, FSI, lease premium, salary, electricity depreciation, provision items, petrol, diesel, etc., etc. Then carve out the capital goods, because capital goods need to be purchased from the registered only, and if it is not from purchase, then RCM will be applicable on that particular thing. Procurement of goods, then comes the input goods and input services. Then there is a cement again compulsory from that. RCM will be applicable on that particular thing. And if it is promoter is on the remaining part, promoter is liable to purchase from the registered dealer for the so far as 80% is concerned. Now this is an illustration that is given in notification 3/2019, disclosing that the manner in which this to be calculated, or whether there is any shortfall in a particular scenario or not. This is the summarization of what we have discussed recently. Goods and services, 18% GST. If at all there is some shortfall, cement 28%, and capital goods applicable rates that are there. Now, quickly going to taxability of development rights. This is what at the starting, at the beginning of the lecture, I had discussed about the immobile property and all. But keeping it aside, that whether the development rights are taxable or not, because I have referred a particular judgment over here, Prahita Construction, wherein they said that GST is applicable on transfer of development rights. Supreme, and then the petitioner went to Supreme Court. So Supreme Court is yet to take it up for the final hearing or final arguments. But meanwhile, it says that it rejects the stay of demand and directs the petitioner to pay the taxes on TDR. So accordingly, the position or the positions as of now seems to be that on the development rights, even though it is an immobile property, it is taxable and tax needs to be paid. Now, considering it as taxable, we'll keep this a basic presumption that transfer of development rights or TDR are taxable. Then we'll go ahead with that particular presumptions. Now there is a distinction between TDR that is transferable development rights, then transfer of development rights, then this FSI, that is floor space index, and long-term lease. Although in the notifications and everywhere the references are given, all are calculated, or all are being treated as at par, but there are basic differences. Transfer of development rights are basically a certificates that are issued by the public authorities like municipal corporation, or by state or central government in consideration of surrender of land. So this is basically a TDR guideline issued by Niti Aayog. I have picked up this paragraph from that. So if I go and do a slum rehabilitation project, and of course, municipal corporation will not going to pay me any as a cash consideration, but it will tell that I'm going to give you a transferable development rights that you can use it in your any other project, or it is freely tradable in the market. You can go ahead and sell to any needy promoter. That is one. Now that is transferable development rights. So that can be said a TDR certificate. A certificate has been issued by the authority. Now transfer of development rights means what? There is a landowner, he does not know how to do the construction, but he approaches a developer like, look, I'm having this land, you are having this specialty of developing, so kindly come to my land, I'm giving you development rights, you come to my land, you do the development, we'll share either area sharing, revenue sharing, whatever JDA will do, we will do that sharing. So that is transfer of development rights, and that was the transferable development rights. So transferable development rights are issued by the public authority. Transfer of development rights are issued by the developer. It's TDRC, the manner in which it is issued. This is development agreement. Purpose is to surrender the rights or maybe slum rehabilitation, and purpose is to earn from that particular land that landowner is having. And taxability, this particular thing, that the public authority giving transferable development rights or FSI are not neither supply of goods nor supply of services as per the as notified under the Article 243G and W. However, supply of the transfer of development rights will be considered as supply, and it would be taxed at 18% under the serial number 16. And we'll see that particular entry. Now, this is what the journey of development rights is. Earlier, it was like a landowner who is registered under GST. That was the word that was used till 31st of March 2019. And after that, they realized that obviously landowner will not be registered at any point of time. So that particular thing they have removed, and any person is said. And if at all landowner is registered, then taxability of transfer of development rights was under FCM, but now it is under RCM. So promoter, I mean, promoter means developer. So promoter is the new term that is being used after 1/4/2019, that the promoter will be liable to pay GST under reverse charge with certain exclusions and exemptions. So this is the journey of transfer of development rights. As I said, the transfer of development rights are considered as an immobile property. In service tax, it was not covered under definition of service, hence it was not taxable. From 1/7/2017 till 30th March of 2019, taxable under FCM because there is no reverse charge mechanism introduced at that time. And after 1/4/2019, it was taxed under reverse charge mechanism. So this is the brief journey that we can understand of TDR and FSI. Same treatment will be long-term lease, because long-term lease of industrial plots that has been given by the industrial development corporations, various industrial development corporations. Now, what problem over here is that there are certain state industrial development corporations such as DIDC, Gujarat Industrial Development Corporation, Maharashtra Industrial Development Corporation, who gives us long-term leases, more than 30 years, 90 years, 99 years, 999 years leases to the industrial units for the development of industry, for construction of factory building, and do the industry from that particular thing. So that transaction of grant of long-term lease from state industrial development corporation to industrial unit is exempted. But what happens in normal scenario is that industrial units may not want to continue after certain 10-15 years, and they want to assign that particular land, that long-term lease, to another industrial unit who is interested in entering into that particular land and start its business. Then on that second leg of transaction, the problem of taxability is occurring. So the entry number 41 of notification 12/2017 is granting the exemption on upfront premium, that is premium, salami, cost, development charges that are being given for long-term lease of 30 years or more. So that has been exempted, but it is qua provider, qua provider means this type of services must be given by the Industrial Development Corporation. So this is the verbatim, extract of the exemption entry, that upfront premium payable in respect of service by a granting of long-term lease of 30 years or more of the plots for development of infrastructure for the financial business by the state government. This is the exemption. Now, when we look at the second leg of transaction, the second leg of transaction is not actually by the State Industrial Development Corporation, it's by the industrial unit, which is assigning or subleasing the transaction to another industrial unit. So therein this exemption cannot be. Of course, we can argue that when I assign, the right again goes back to the Industrial Development Corporation, Industrial Corporation enters into the tripartite arrangement, and then it subleases the incoming industrial unit to operate on that particular thing. However, across the country, the department has taken this view that on the second leg of transaction, GST is applicable 18%, and tax authority has started demanding GST 18%. We being part of a Chamber of Commerce and Industry, we have filed a writ petition challenging the applicability of GST on transfer of development rights. We also represented before the highest authority over here. Let's see what happens in future. But as of now, the department is having this view and they started demanding and issuing the show cause notices. Similarly, in certain scenario, the long-term leases are given to the developer right away by saying that you can go and develop the land, and you can sell those units to the residential or commercial units to the customer or end customer. So that grant of long-term lease from the local authority or the government authority to the promoter or that particular transaction is again exempted by way of 41B. Again, this is something which is exempted by way of 41B, but there is some conditions attached to that. Let's see the conditions. That exemption is available only for the residential units, and the condition says that if the residential units, all the residential unit that a developer or promoter is going to construct on that land, long-term, the land taken on long-term lease from the authority, that the transaction of long-term lease, and I can couple it with the FSI and TDR also because that is the same exemption, that transaction of long-term lease will be exempted if all the units that has been constructed will be sold before the completion certificate, before the receipt of completion certificate. So in short, government want to say is that, look, whatever construction you are doing on that particular land, on the entire construction, you are going to pay the GST of 5% or 1%. See, we are talking about only residential. On commercial, that reverse charge is applicable, 18% GST on reverse charge, the promoter needs to pay. But on the residential part, government says that, okay, we are going to give you the exemption on that particular transaction, but all the units needs to be sold before BU. So on all the units, you need to pay GST at 5%. If you're not paying, then on the proportionate amount, you pay GST at 18% on reverse charge on the transaction of long-term lease or TDR transaction. We'll show you the exact understanding. Yeah. So for the this is the residential unit that we are discussing as of now. Who is liable to pay the tax on long-term lease of land? Promoter of land. Exemption? Yes, exemption is that units sold up to the receipt of BU or CC, no tax. If units are sold after the BU, then tax is applicable. Time of supply, any month before BU or in the month of BU. Valuation, lease premium paid proportionate to the unit, and of course 18%. So manner of calculation of tax is also given. It says that lease premium into 18% into unbooked carpet area divided by total carpet area. Now that amount, compare it with whatever unbooked units are there with the 5%. Whatever is lower amount, you pay that particular amount under reverse charge mechanism. And valuation of unbooked units, because I need to value the unbooked units of on which I want to calculate 5%, equal to the value of similar apartment sold nearest to the date of BU. So for this particular residential project, if I'm taking any services of long-term lease, I'm taking the land on long-term lease, or I'm taking it on TDR from a landowner. So this particular transactions or this particular arrangement of tax will be applicable to that promoter. ITC, obviously it is a residential project, so ITC is not allowed. And now coming to the commercial project, obviously has to pay under reverse charge. There is no exemption. then immediately on the date of payment, whereas and when the date of payment is lease payment is paid, 18% applicable, and obviously there is no need for valuation unbooked units because entire will be taxed at 18%. And obviously, because the commercial units will be taxed at 12%, so lease premium at 18% will be, ITC will be eligible. So this is that exemption entry. This is that reverse charge RCM entry that has been given in 13/2017, which says that RCM will be applicable on the promoter for this long-term lease that is used for the construction of the project by the promoter. And this particular rate entry says that 9% GST or 18% GST will be applicable on such transactions. So again, when this long-term lease are being taken by this particular land owner and it has been given to the customer. So when we have discussed about the transaction of long-term lease taken by the developer, now using those long-term lease at the land of long-term lease and giving the construction service to the end customer. So it will remain same, no change in the taxability. So freehold land or leasehold land, the GST rate will be 1%, 5%, or 12% that we have discussed. 1%, one third of land deduction are allowed, and ITC will be eligible on 12% for commercial units. And again, this 1% is challenged, as we rightly discussed in that Munjal Manish Bhatt case law of Gujarat High Court that is pending with the Supreme Court. Nishal, how much more time is left for to conclude this?
So you can continue with the question and answer session.
Okay, so I'll quickly go to this chat box. There are certain questions that has been posted over there. After that, we'll take if any questions are left. What is affordable housing definition? I think we have discussed that affordable housing definition. It is having these two mandatory conditions of the carpet area, 60 and 90 carpet area, coupled with that total amount of 45 lakhs needs to be seen. So that both condition needs to be fulfilled for the affordable housing definition. How to match the taxable value with ITR? I'm sorry, I will not be able to guide you about the income tax and the manner in filing of income tax returns. If the maintenance is below 7,500 per month, but above rupees 20 lakhs, then GST registration required as aggregate includes the, yeah, I agree that aggregate turnover includes the exempt supply. But there is this section 23, I guess. It says that if there is only exempt supply, then you are not required to take any registration. So if at all there is any other taxable income, then obviously you can go ahead and take the registration. Otherwise, you can take the benefit of section 23, which says that if you are engaged exclusively into the business of supply of goods and services or wholly exempt from tax, then you need not take the registration. So yes, if any transfer charges are collected by the society, then there is no exemption, and then you have to get the registration. Yeah, PPT will be shared by Nishal. In case of joint development agreement, who should pay the GST, builder or owner of the land? This is what we discussed, that RCM. In case of transfer of development rights and this developer needs to be paying GST under reverse charge. For the joint development agreement entered in 2018 for the transfer of development right, who should pay GST? Okay, yeah, this is what we discussed, that during the period 1/7/2017 till 31st of March 2019, it was under forward charge. But the critical part was that if the development rights are transferred by a registered person, that is what was mentioned in explanation 2A of that notification, and taking the benefit of that registered word, we can say that, look, a landowner was not registered, so nobody was liable to pay the tax on that particular transaction. However, this needs to be tested in a higher forum. RCM is applicable on the rent paid to the old flat owners in case of redevelopment. I understand that RCM is actually not payable in this particular scenario, but because the rent that is paid to the old flat owners is part of your development cost, and on development costs, you are already paying GST. So I think RCM will be not be payable on that particular thing. ITC availability to the developer in case of GST paid on JD. I think part we already discussed that ITC will be eligible only on the commercials. Otherwise, it will not be eligible. Residential villa are constructed by the builder who is owner of the land. All the necessary permission, NA, NOC taken by the builder in own name. Development scheme is taking place. Whereas RERA is not applicable. See, in entire GST law or in the entire notification, it is not mentioned that a project is covered under RERA or not. It is merely referred to a particular word or a definition, said that for this particular word, you have to go and check the definition of RERA. Now, whether that project is under RERA or not, you have to mandatorily refer to a RERA definition if that particular amount or that word is applicable on this particular in your project. In scheme arrangement, the sale of land is entirely separately and construction agreement is separately. In the construction agreement, whether GST at 1% or 7.5%, or see, if land is being treated separately and remaining part is being treated separately, I'll suggest that it would be 18% on construction services only. I'll just share that slide. I'm having that slides in subsequent slides. We have purchased TDR from landowner, but we have not started the construction yet. The RCM applicability liability should be paid. It's on the date of completion certificate or the allotment of the units to the developer. That is what is being specifically mentioned in the notification 4/2018. The state transaction is shown. Yeah, that they will show, obviously show, because when they will raise an invoice, they are going to show it as an RCM. But if at all it is I'm using it for residential units, and if residential units are exempted, then I need not pay even though it is being shown in RCM. So this can be again result into a problem when department come to us that they look this and again the department has started taking help of that some software saying that okay, in your GST to be this RCM is being shown that you pay it under RCM. Then we have to convince that look, this is not applicable because we are into the commercial, not into commercial but residential. GST rate for the commercial project in case of JDA that we already discussed. Very good content. Oh, thank you very much. What is the GST implication on rent paid by the developer to the unit holder in case of redevelopment? This is, I think, we have discussed already. Sir, if the project started in 2016, advance paid on flat in 2016, and BU is Jan 2017, but invoice is raised. See, everything is done in 2017, before 2017, even though you raise an invoice after, no tax implications, because the event of taxing event has happened before that. So merely raising of document cannot define a taxability, so it will not be taxable. And since you asked this question, I'm just going to cover that also, that if you entered into a development agreement before GST, then also there will be no GST implication on that particular thing, transfer of development rights. In case of housing society, whether we can take ITC on repair of road, drainage, if you're paying GST on that on your maintenance charges, then you can take ITC. Otherwise, if it is an exempted, then as per rule 42 or section 17, you cannot take the ITC of road repair. And yeah, one more thing, since this is a road repair and drainage system, it can be said as a works contract or something like that. So it's compulsory, needs to be revenue rather than capitalized to come out from from the block credit of section 17.5. Nishal, I think I have covered all the question and answers. Hold on, there are certain more. Can ITC be claimed when supplier's RC was cancelled? Okay, this is not relating to ITC, but I think it can be claimed because if there is no allegation of bogus billing or something like that, then ITC can be. I mean, there is no condition which is stopping me that RC registration is cancelled unless he has not filed his GST at 3B. Because then section 16C condition will be violated. A contractor working for developer will be receiving his remuneration in kind of developer by way of allotment of flat. What will be the point of taxation? That can be decided, at some point of time, that the allotment will be done. And if that agreement to allot that particular thing happens after completion certificate, then no GST, and if it happens before, then GST will be applicable on that constructed flat that has been allotted to the contractor. That can be worked out, because generally this type of transaction happens only after BU, when this contractor comes for the final settlement of his invoice in consideration of the services that has been provided. Can you please clarify the taxability of corpus fund given by the builder during redevelopment? On corpus fund, I don't think GST will be applicable. That should not be termed under the definition of consideration. Should permission charges, stamp duty charges, municipal charges be included? I think taxes can be excluded, but other charges should be excluded. But there is this clarification by the government saying that any charges paid to the government needs to be excluded for the 80/20 rule. So that you can check for this 80/20 rule, and accordingly, there's certain charges can be very well excluded for calculation of 80/20 rule. Sir, consider the scenario project started in 2016. Again, the same thing, I think. It can not be shown in your exempted supply. I think I have covered all the. Hold on. ITC of leasehold property purchased is eligible. ITC of leasehold property purchased, I mean, tax will be of lease or construction, because leasehold property means ITC of leasehold property purchase means it would be construction services, or I don't understand that. The last question. We have taken TDR rights for the construction of office premises for own use. Then what will be the taxability? What will be the taxability for own use? It is not actually, there is no supply, there will be no supply, your output supply will be nil. No? So this can be said as a no business transaction, but reverse charge can be said as applicable, Neha. Can we get refund of GST paid to the developer before BU? And yeah, this refund can be taken. I mean, there is a clear circular issued by the CBIC that my individuals can go and claim the refund. Even though I'm an unregistered person and customer, then also I can go and claim the refund. How is it different from construction service on freehold land? I am okay. Mani Kumar, I am not able to understand the question. For the construction services provided by the contractor for the construction of vessel, GST rate 18%. It is different from the works contract service and construction services are both different, because in case of a construction service, these are provided along with the undivided share of land or freehold land or maybe leasehold land, and the construction done by the contractor is works contract services. So that rate is different. How is construction service valued for freehold land? Construction service, that is what we have discussed, I guess, 1%, 5%, or 12%. Yeah, Narayan, you have raised a proper question that should we reverse the ITC, or should we keep waiting for Safari retreat? So along with this Munjal, Manish Bhatt and Pratiha construction, this Safari retreat is also something that we are waiting for, some positive outcome we are waiting for. So I think the practical call will be not to utilize such ITC, keep waiting. If at all Safari retreat comes in favor, you can take benefit of it, or you can reverse because without paying of interest, because ITC not utilized and reversed after thereafter, there is no need to pay interest. So that can be a practical call, Narayan. I think Nishal, we have concluded with the questions. Mostly I have covered all the questions.